All right, welcome everybody to today's special edition of our webinar for Thursday. It's titled COVID-19, Beware of the False Dawn. So we'll get started shortly. As I said, it is a special edition webinar, a commitment from the LTG team to bring you additional information, and we certainly aim to have these special edition webinars at least once per month to bring you further updates in terms of what's happening in the markets. Now, before we do get started, I am obliged just to go through some minor formalities and advise everybody that obviously anything that we've covered today is for educational purposes only, and not should be taken as personal advice. All right, so today's topic, before I hand you over, let me first of all make a formal introduction of V. V has become part of the LTG team and is in fact our Chief Market Analyst. V has over 20 years experience in the financial markets. He's worked for the major investment banks like Morgan Stanley, Deutsche Bank, JP Morgan, co-founded a large investment hedge fund with assets peaking at $1.2 billion. So certainly a very experienced campaigner and a huge asset to be part of the LTG team. Now, in fact, there's actually a whole team behind V. So the daily reports that are produced by V, there is a whole team behind him. In fact, in 2016, V did co-found a company in Singapore called Track Record, and they in fact actually provide training for all the major investment bank and hedge funds. So these the big boys like Morgan Stanley and JP Morgan, all these guys, they send their traders to V and his team for training. So certainly it's a major plus for not just LTG GoldRock itself, but certainly for all of our members to have access to such experience. Now, part of that's not only just his own personal experience and his experience of his team, but his network. He has direct access to the network of the investment and hedge funds, so he has first-hand knowledge about what the big money is doing in the markets. So that's my little spiel of V. I think you'll find today's session absolutely informative. So I'm going to hand you over to V, and I'm going to just apologize in advance because obviously V's in Singapore, and we're trying a back and forth in terms of technology. So I'm going to hand it over to V and get him started with the presentation.
Okay, thank you, Alex. Thanks for the kind words. We shall begin today with the first seminar, hopefully of a series about markets and what we should do to profit from the markets. And it's quite interesting times now. We'll start with COVID-19 because it's, of course, now the primary focus of every policymaker on earth, except for the ones who are really complacent, then they still think it's just a flu. If any of you had contact with me before, you would know my views about this. I suggest that if you haven't, then try to Google it and try to look it up so that I don't have to repeat the whole thing. I think today we'll spend some time talking about the second stage, which is what has happened is we will first talk about the state of the world right now. And previously, not many people are aware, I think, or up to a few weeks ago, most even governments think that this is just a temporary thing. And in fact, some still believe this is a temporary thing and it's not a big deal. But in fact, I believe that it is a much bigger deal than any of them expected, or some of them still believe their own spiel that it is not such a big deal, it'll just be a passing crisis. Then we'll talk about the first stage of the crisis briefly, where we've gone through the first stage of the crisis, and we'll talk about what the good news has been and what the bad news is. And we'll talk about the policy response from various governments around the world in general, and then what are the consequences of the policies. And I believe now we are in the second stage, and I'll explain to you what I believe the second stage entails, and hopefully then we can learn how to prepare ourselves on how to trade and invest and profit from this. So the layout of this thing, I guess it would be much different from what you typically get from mainstream media, in that they'll tell you some facts and then just tell you the analysis. But I'm hoping to give you a set of questions that you can constantly use to ask a set of principles as to how to think about the world and how to structure investment and think about consequences of the policy makers' response, as well as the inevitable spread of the virus. So hopefully it is something that not just give you a fish, but teach you how to fish such that you can profit from this over the long run in different crises. There's in the future, some of us are still young enough to see many more crises down the road, right? So the state of the world currently, I think there's no need to spend too much time on this. As I was preparing this, yes, the world was still quite complacent about some parts of the world, quite complacent still about how big of a crisis this is. But I think now it's quite obvious with many countries shutting down, Australia being very strict as well. Singapore just went into the second stage lockdown, which is much more serious than the first stage, which was quite mild. And US, Europe, they're all going through the same crisis. And more importantly, it's become very obvious now that the job losses are of a scale that is unprecedented. And we are becoming numb by numbers that we see of millions of jobs being lost, right? Millions of unemployment claims all around the world. So this is in stark contrast from a week, 2-3 weeks ago, where many investment banks and so-called experts on policies and economic macro fundamentals, they were still saying that this is just a slowdown. It's we still have growth. But now they're coming to realize that that there's revisions from investment banks where they have minus 10% of growth for this quarter and things like that. Those are more realistic, right? Because you shut down many economies around the world. And the first stage is the COVID virus. At first, not many people know about it. Everybody seems to think it's a Chinese problem. Then it became an Asian problem. Then it became a European problem, and then finally, US realizes that it is their problem, right? Of course, I think that this is a global problem, and right now, many countries in the southern hemisphere, they are still quite insulated. For some reason, the president of Brazil still think it's not a big deal, but as evidence in Australia, it is a big deal. In New Zealand, it is a big deal. It doesn't matter which hemisphere you're on. Eventually, the weather becomes cold somehow, right? And after the spread of the virus, we have the when it first broke, the news broke, it became the big deal. We had massive sell-offs in asset markets, in the stock markets, in the credit markets, in the bond markets. So anything that you can think of, everybody was trying to sell because they were losing money on it and they faced margin calls. I'm sure for LTG members, margin calls is something that you've never heard of. You're all doing so well. Nobody has been forced to liquidate before. That's because you are associated with a good trading education firm. But outside of this world, many people tend to over leverage. Private bankers will sell you many structured products where it looks really good when times are good, but when times are bad, it just absolutely there's no exits, right? So I still have friends who talk of calling their bankers and asking for a price to get out of their portfolio, and the price it used to be maybe 95 cents to $1, and the price that's shown to them is maybe 55 cents or 60 cents at best, right? and what was last traded, there was nothing traded. So there was a lot of margin calls and forced liquidation, and that's why the policymakers had to really come out in full force to support the markets by easing monetary policy, cutting rates, and instituting programs where they will buy commercial paper, they will buy credit, they will buy bonds, they'll buy in countries like Japan, they were buying equities. In Australia, the RBA was buying bonds, and they were targeting 3-year bonds at 0.25% yield. So it was all to save the market from a meltdown. Of course, it did look for a while like it was a meltdown, but the policy response was very, very strong. And I'll explain why later. It is unprecedented. And now we've come to realize that the job losses are inevitable with all the industries shut down. Non-essential industries are all shut down. At first, it affected airlines, affected tourism, affected a bit of restaurants, a bit of travel agencies, and then cruise liners. All the first layer, it was was obvious. Then now it's down to in Singapore. The shutdown is so strict. It started on Tuesday. Only essential businesses are allowed to open. That means food stores, restaurants, but no sit-in. It's only takeaway or delivery, and banks. And you need to get permission if you are part of a supply chain that needs to be open. But other than that, any other business that is not allowed, is not essential, is closed, right? And that is the case with many countries around the world now in different shapes or forms. So we will have demand destruction when you're hunkered down at home, you're not thinking of going shopping. Of course, online shopping is probably experiencing a boom, and food deliveries, grocery stores, Walmart is making push to new highs in the stocks. But other than that, most businesses are getting crushed. If some of you are business owners, you will know exactly what I mean. I have friends who are in F&B and they're thinking about how to not retrench their workers. So in light of that, and in anticipation of that, the policymakers, Federal Reserve, RBA, ECB, BOJ, all these alphabet soups of all the central banks around the world, they responded swiftly and decisively for change as compared to previous crises. I think for once they have learned from the 2008 crisis and realized that there's no need to hold back. Better to err on the side of caution, do more than do less, do not wait and see. So that is the first stage, and that has led us to the second stage, which I will describe further in more detail. But the good news with the COVID so far is that social distancing flattens the curve. We are seeing the infection rates and mortality cases peaking in Europe, in New York, some parts of USA, and that's why we are seeing a lot of optimism in the markets. So it's important. I think one of the primary things that you need to remember is that it's important to always anticipate what comes next, right? That's why the market started selling off before COVID was a big deal in the US. It was just starting in Italy and in Iran and Spain. Then people, the asset managers or the leverage investors realized, oh no, this is not good, right? One starts to get out, a few starts to get out, everybody starts to get out, and then it starts going down. And because of that, all the forced liquidation has happened, and also Fed has stopped the panic with their policies. We see that now the market is pricing in the flattening of the curve in Europe, in New York, and from this chart is a very simple chart. Without protective measures, you see in the blue area, it is what happens in countries where there was no social distancing. That's what happened in Iran. In the beginning, the health system was overwhelmed, and you have mortality not just from people with COVID, but also from other diseases like maybe heart attack, emergency cases where you need to the ICU, but the ICU is all fully occupied. You cannot take somebody off the ventilator. So that's what happened. People had the medical healthcare workers had to choose between who lives and who dies, and what happens in Italy. And finally, when ultimately when they impose social distancing, you flatten the curve. You do not really eradicate the virus, but you stopped it from spreading so fast exponentially, such that your healthcare system is able to cope with the number of people coming in. So this is the good news. The bad news is that although we have found a way to deal with it for now, it's not going away anytime soon. It's not as evidenced in Singapore and Japan. These two are the countries which were the first to get it outside of China, and it seems all going well. Singapore, I can guarantee you, is one of the best run cities in the world. They have healthcare systems, that healthcare hospitals and clinics that is beyond most countries. The standards of care is beyond most countries, and their contact tracing, which is what they use to good effect in keeping infection rates down, is that when they find one infected case, they found all the people that came in contact with the guy and quarantined that all these individuals, and they slowed the virus. And yet, they thought the crisis was over because they kept it under control. It's gone. The spread is somewhere else. But they let the guard down, or not really. They let the guard down. They didn't increase their vigilance because they thought what they did was enough. They didn't account for all the returning citizens from the rest of the world, which were now blowing up. They all came home, and all the imported cases, instead of keeping themselves at home, thinking that Singapore is a safe place. They went out to party, they went out to meet their friends, they went out shopping, they went out to eat and drink with their friends, and soon all the imported cases started a local community spread again. And last week, the Singapore government realized that there was no choice. It's now in the community. They had to shut it down. So this is a piece of bad news that I think currently is not priced correctly, because this is something that puzzles me. When this virus started spreading in China, Wuhan was shut down. The whole world was thinking it's a Chinese problem. It's because the Chinese government is inept. They were covering it up. They don't know what they're doing. It's a bunch of incompetent people trying to hide the facts. But that whole playbook was adopted in every country in this world after that, right? In the US, Trump did the same thing. In the UK, Boris Johnson said, it's not a big deal. I'm going around shaking hands in the hospital. I think it's okay. And he says the best way to do this is to have herd immunity, and we'll try to get as many people infected as possible. And now he is in ICU, right? I think it is ironic that all these guys who criticize China did exactly the same thing as what the officials in Wuhan did. They tried to deny that it happened, deny that it's a big deal, until finally the numbers were so big, they say, oh, I told you so, it's a big deal, I'm shutting it down right now. And now again, the experience is that they keep saying now, if Trump, if you watch his press briefing every day, he repeats the same thing again and again. Oh, we are seeing the peak is soon, we are going to reopen our economy, we're going to get started, the economy goes on. But the key thing that they miss is that, yes, you can slow it down, you can flatten the curve, but if you restart and you go back to life as normal, you will have the experience of what happened in Singapore, what happened in Japan, and in fact now even China, which is extremely strict on imported on people coming into their borders, they're having renewed cases or imported cases in some parts of China. So this is not going away anytime soon. Countries still vulnerable. Brazil, Latin America, the Brazilian president was going around doing rallies and shaking hands and telling people it's not a big deal, we'll defeat the virus, just by his pep talk, I think. So in other parts of the US, although the parts like New York City, California, all the parts that started first, of course, inevitably after you have enough cases, you frighten enough people, they take the social distancing seriously, the spread slows down, right? But in other parts of the country where people don't see their friends getting infected, they don't see it affecting anybody that they know, and they're watching TV, and the president tells you it's okay, we have a cure now, it's good to go. They will continue living life as they did before, and they are vulnerable to the spread of the disease. So that is the bad news, unfortunately, but that's the state of the world. And we can see, the death tolls are accelerating in most countries. It just happens that they are not the prominent ones that we talk about. So in some countries are still in the very early stage of the spread. For example, Mexico, Morocco, all the countries that are exotic, and they don't really come out in the news that much, because in the news are countries like the US, the UK, and parts of Europe. So, for example, I find it really hard to believe Indonesia, with a country with a population of its size, has less cases than Singapore or Malaysia, and we have the same weather patterns, we have the same sort of lifestyle, except Indonesia is a much poorer country. The healthcare facilities is much poorer. So the only is much worse. And the only reason I can think of is that, as the case was with many countries where they claim to have no infection, is because they're not doing any test, right? If you don't do any tests, you don't have any infection. If you do 100 tests, maybe you have 50 infections, right? So when countries, after they ramp up the testing, they realize, yes, we have a lot of cases, and that's the experience of the United States as well. And that's going to be the case with many countries around the world as well. And the tests are still expensive for some of these countries, so they'd rather not. And in India, it's very worrying. The virus has spread to one of the major slums in the cities. And as anybody who's watched any movies on India, you know that the conditions in the slum is that it's just no social distancing, right? It's just right there, a group of people, thousands maybe, living in a small area, and they're very vulnerable to this. And eventually, it shows up, regardless of test or not test. The sick people will turn up at the hospitals, and that will become a serious problem for the country. So, with that, what are the misconceptions? The misconception that's been around from day one is that warm weather will save us all. They think, when summer comes, the US will be safe, the northern hemisphere will be safe. But for some reason, they've forgotten that there is a southern hemisphere that goes into winter when the warm weather comes to the northern hemisphere. As Game of Thrones says, winter is coming. It's always coming somewhere in the world, except for countries like equatorial countries like Singapore, and yet Singapore has problems and Malaysia has problems. So yes, the warm weather helps in that hotter temperatures makes it more difficult for the virus to survive outdoors, but most of the infection happen indoors. And as far as I can tell, in most countries with any bit of money, the indoors is not that hot, right? It's usually air conditioned and all. So the misconception is that it will mutate to a milder strain, as SARS did, H1N1, or all the other viruses before. This is not something that's guaranteed, and it's not something that we can bank on. A vaccine is around the corner. We hear this every day in the newspapers. Some companies will claim that they have the virus in development in various stages. I think the best person to listen to on this is Bill Gates. If you have not heard Bill Gates' TED Talk on pandemics, he gave one talk a few years ago. He warned of a scenario much like this, in fact, exactly like this. And he's been talking about this as being a big risk to the world. And he's right. And what his foundation is doing right now is investing in 7 different vaccine possibilities. And the reason why he's doing 7 is that he believes not all of them will be successful. Maybe even not any of them, but he hopes that by doing all simultaneously and spending money to do it, he shortens the time to get to a vaccine, right? Because every month that it's without a vaccine, the economic damage to the world is in trillions of dollars, as opposed to spending billions of dollars on 7 different vaccines, and he's funding it with his personal fortune. And interestingly, he's good friends with Warren Buffett, and Warren Buffett recently disclosed that Berkshire Hathaway sold some of the holdings in airline stocks, right? If Warren Buffett believes that this is a short-term thing, come a few months, it's over, he will know that airline stocks cannot be at this depressed levels forever, and there's really no need, given that he's a long-term investor, there's really no need for him to divest. Probably it's a good time for him to invest. But I think we all know who Warren Buffett is. He rarely makes mistakes. If he's divesting, there must be a reason. And him being good friends with Warren Buffett, I believe that they are of the opinion that the vaccine is months away, at least 12 to 18 months away, as is stated by most experts in this area. Of course, Donald Trump tells the world almost every day in his morning briefing that there is a cure, chloroquine, zinc, and by antibiotics, and he's prescribing all this to different people in this world via his press conference. I'm not, but all the health experts say it's inconclusive. So it could be, to use his words, he feels good about it, right? But he feels good about many things in this world. He felt good about reopening the US economy during Easter. Before Easter, as far as I know, Easter is this weekend everywhere around the world. So what he feels good about is not always true. In fact, most of the time it's untrue. So I wouldn't bank on that. Oh, sorry, a bit sensitive. And so we'll come down to the policy response in light of all these things, all the things that we've spoken about in the previous slides about panic selling, economic damage, job losses, and all. The policymakers have responded in a fashion that we've not seen before. To contrast that with the policy response in 2008, as we know, I assume that everyone here knows about the 2008 credit crisis, probably lived through it and struggled with the businesses or jobs that happened at the time. You can see the first Fed rate cut that was significant was in 18th of September 2007, but previously, prior to that, they were cutting in 25 basis points because the economy was slowing, but that was the real cut in September 2007. They say, oh, something is bad, we're going to cut 50 basis points. And finally, they reached zero rates in 2008, December 16, 2008. So it took them a whole year and some months before they went through everything that they had. So they went, if you look sequentially, they cut 50, they cut 25, 25, and then 50, 75. They were just feeling their way because they were responding according to what they know before, which is central banks are always very conservative. Let's cut and see what happens. Let's cut and see what happens. Let's cut and see what happens, right? They implemented different lending programs. They did bailouts. The Fed, the ECB joined in as well. And they had cash for clunkers, fiscal policies, all various things. It took them a long time to respond properly to the credit crisis that the world was facing. And contrast that with the ones that we see this time, the policy response was extremely swift in that it surprised many people, including myself, as to how resolute they were. The first cut was an unscheduled cut on the 3rd of March. They cut 50 basis points. And the next cut was 2 days before their scheduled meetings. And March 15, they were supposed to meet on March 17, but they cut 100 basis points. They couldn't even wait 2 more days. They cut 100 basis points, and they announced bond buying programs, quantitative easing, and then dollar liquidity, meaning that each time that there's a crisis because the world is funded in dollars, many people borrow in dollars because corporates borrow in dollars because it's the deepest, most liquid asset markets, credit markets. If you issue bonds to borrow money, it's much easier and much cheaper to borrow in dollars. And when bad things happen, you need to pay back all these loans. You need to hedge your dollar exposure. So dollar funding became really expensive. So the Fed, as a lender of last resort, not just to the US but to the world, they announced that they were going to provide dollar liquidity to central banks around the world so that they could in turn lend these dollars into their local markets to stop the panic. And they did all that in the space of a month, in less than a month, from the 3rd of March to finally the fiscal $2 trillion fiscal bill, which is the 10% of the US GDP. It was all passed within 1 month. And on the 23rd, it was very significant that the Fed did not wait to see the effects of their policy. They just went to say, we are going to buy unlimited amounts of bonds, which is what RBA did as well. RBA was historically has been very conservative and very reluctant to cut interest rate, reluctant to go into quantitative easing. But when they launched their bond buying program, they said there is no amount stated. We will buy whatever is required. And that is the mantra of most central banks. In fact, all central banks right now is they will do whatever it takes. It's better to do too much than do too little and suffer the consequences. So within the space of this 1 month, they have done everything that was everything and more than what was done in the 2008 crisis. So in hindsight, it is now, of course, obvious because you see the stock markets has responded in kind. The bond markets have stabilized. The credit markets have largely stabilized. What does this policies? What does it do? It stops the panic because now you know the Fed is out to help you. The government is out to help you. There's no need to panic. There's no need to liquidate everything because there is going to be light at the end of this tunnel. Of course, how long is the tunnel still remains to be seen, but it also allows for orderly exits. Some people have no choice; they have to sell because they need the cash. They need to get cash to for other purposes. They need to get out of their portfolio of assets, and to sell at the extreme lows would have been very painful. For example, now in Australia, the government has instituted early release of superannuation funds for those who are badly affected by the crisis. You are allowed to withdraw 10K before middle of this year, and that will put stress on the superannuation funds in that they have to liquidate the assets. Imagine if the governments have not come in to intervene in the asset markets, they will be selling this at 50% down. And your portfolio, you intended to withdraw 10K, but by the time it's done, it's 5K left, and then you have to sell twice as much to get the same amount of money. It will be really, really bad. So they had to do this, and they managed to stop this panic. It cushions the economic pain. The fiscal policies have been largely geared towards giving unemployment benefits, giving corporates tax relief so that they could keep their business open and not sack their employees and try to stop the confidence crisis, and it spirals. If it was allowed to happen, job losses lead to forced sales of assets. Forced sales of assets leads to even more job losses, and it spirals downward, right? So they've managed to stop this vicious cycle for now, right? But what doesn't this policy response? What does it not do? It doesn't create prosperity. Governments around the world are printing, but it is just printing, right? They are not creating anything. It is not increasing productivity. It's just a stopgap measure to stop you from panicking, to stop you from thinking that it is the end of the world. So it does help with the panic selling. It does help with the confidence crisis, but it does not help with the demand destruction. It does not help with the supply disruption. And it does not help with the productivity of the whole world suddenly now comes to a much lower level than we've ever had in recent history. And it doesn't change the fact that the virus is still out there and social distancing is our only defense against it. And it is required if we want to control the spread, right? So that is and something that I've spoken at length about. I believe it is inevitable that it's either we social distance as a proactive measure before the spread is too big, or social distance after the spread has become too big and you realize that you need to do something about it. But whatever it is, the way that we live has changed. The way that we conduct business has changed, and that will continue to be so until we find a cure or find a vaccine for the virus, or the virus conveniently and cooperatively decides to go away. But until that happens, this is the world that we live in. We are now going into the second stage of the crisis where, yes, the governments have stopped the panic, but they are trying to mitigate the economic damage. But at what price, right? But first, what happens to the asset markets? Because of the wave of money that's coming into the system, the asset markets naturally is supported, right? Because what happens to the asset markets is the converse of what happens to fiat money, right? Fiat money, if you believe in the demand and supply, and demand supply typically is correct, is that the more you have of fiat money, the less valuable it is, because it's just printing, right? There's nothing to back it. There's no purchasing power behind it. It's just the government's starting the printing press. If there was a way to print yourself to prosperity, many banana republics of the past would have been the richest countries in the world. But what tends to happen is that when you print a lot of fiat money, everything that is hard assets will redenominate itself, it reprice itself against fiat money, right? That's what we are seeing right now. We see stocks going higher, we see gold going higher, and we see that that's why I believe, because of the swift response, the amount of stimulus that is introduced into the system is such pace. We see this the purple line is the asset markets, the stock markets, S&P for this crisis. We see the fierce rallies from the low, but that also happened in many crises before, as you see in 2008, 2000. And in 2000, in bear markets, that's typically the part where it all seems okay now, and then you have that rally. Don't take my word for it that the massive amounts of money changes the price of hard assets. Just have to look at the price of gold. Gold was trading down in March because of deleveraging, which is contrary to what most people believe. They think gold is a safe haven asset. If the world is melting down, gold should be going up. But gold is also an asset that is bought with a lot of leverage, a lot of structured products that allows many people to buy maybe $10,000 worth of gold by putting $1,000 in their account. So when bad things happen, the flight to cash happens first. So you have a massive liquidation. And it was still hovering at the lows. If you look at the black arrow, this was exactly the point the gold was trading on that day. And on the announcement, it happened in the U.S. evening, in Asian morning. They basically said, we are going to buy unlimited amounts of treasuries. The week prior to that, they announced that we were going to buy $700 billion of asset, and within the week, they almost used up the whole quota. So they announced this in the night. They say, okay, we are going to buy as much as is needed. There is no amount in our mind that will stop us. And immediately, gold took off for the races, right? And it's never come back to this level. It's now stabilized at a high level, and gold is a finite supply of gold. There's really no utility besides store of value. Of course, jewelry just to show off to your friends as well. And what has happened, this is a clear case of fiat money being printed in large amounts, and the market immediately prices it, and they reprice gold in terms of money, and now they're repricing assets in terms of money. But that does not mean that it's going to be forever. Of course, there are banks calling for example, Goldman Sachs is calling for S&P at 3,000 by the end of the year. But what are the key risks to this scenario of prosperity, or not prosperity, of euphoria, right? Where everything is going well, the central banks can save me, the governments will give me money. The key risk is that there is a resurgence of the virus in certain countries like Singapore and Japan, and I do not believe this is I do not believe that this is an anomaly. It's not that these countries are badly managed. In fact, these countries are probably the best managed in terms of, especially in Singapore. Japan was a little bit slack as well. They wanted to go on with the Tokyo Olympics for the longest time. But it proves that if you let your guard down and your population starts to get complacent, they start to think, yes, it's okay. The virus, if it's not watched properly, the resurgence happens, right? Or spread begins again. If travel is restarted, all you need is one guy to have the virus, one person, he infects two becomes four, and it starts all over again, right? And the economic impact, although we can think about it, but it is of a scale that is unthinkable, right? We have never seen something like this before. You imagine this is, and the reaction of many people would be much different if this was a terrorist attack and it's simultaneously happening in all countries in this world, right? If you start to think in that terms, you'll see, oh, actually, the economic damage will be massive, right? It's not just one September 11, which we have an enemy to bomb and we can stop them. This is a silent enemy, and it is going to happen around the world. And the economic impact, the only way for us to stop this virus is to shut down the way that we shut down our social life. I mean, you can have social life but online, and curtail our activities and only restrict ourselves to meeting people that we live with. So this economic impact will start to show in time to come. I believe all the pessimistic economic projections are factoring in the likelihood. They have the likelihood that this stops in after you control the virus. But the scenario that we have seen in Singapore and in Japan is that it doesn't stop, right? It only stops if the world simultaneously shuts down, and then we stop the spread, and it's been eradicated, and then we reopen. But that's not going to happen because everybody around the world has a different time schedule. They're never going to be so cooperative. They prefer to blame each other than to cooperate. We see the two superpowers of the world doing that at this moment. So what happens is the red line, the red curve is the no social distancing, unmitigated explosion, but we won't see that now. I think the world has learned to cope with it. They have managed to go to the green, but many do not see the light blue, which is what is happening to Singapore and Tokyo and Japan right now. And that eventually will be priced, I think, right? So there was a lot of euphoria in when Dow Jones and S&P has the biggest updates in history, but of the 20 biggest updates in history, only 3 had continued up moves after the fact, right? Most of it was centered around zero, In fact, the average is minus 18% after the fact. There's some which went on to go down 50% after that, right? So this is not a projection or a forecast, but it's just a word of caution. Don't get excited. Don't give in to FOMO. Don't get super invested because you think you've missed your chance, right? My experience has been that I actually only fully invested tech stocks in 2013. That's 5 years after the start of the crisis. It's three to 4 years after the end of the crisis, according to different measures. But years after the crisis, you still can get in at good price. Yes, it will be all-time highs. When I went in at the time, to any people, it's all-time highs, but all-time highs can be all-time highs for many years to come. But I think many people are conditioned to, I cannot buy higher because it was lower before. But if you try to buy low, it can go even lower, right? It's much better if you want to become fully invested, after it's clearly the end of the crisis. So right now, I do not believe it's the end of crisis. I could be wrong, as 3 cases in history has shown. If I lived through those times, in fact, they're very close to each other. If I lived through those times, I would be wrong. But I think, given the statistics, given what I know, I think the chances are I will err on the side of caution and try to be prudent. So in terms of, I think many of you will have seen this chart of different phases of the asset markets. We in early January, we reached a new paradigm. Everybody was saying the prices can never go down. In December, I remember vividly, everybody is still fearing the recession. Most of last year, everybody was criticizing the Fed for acting too slow, that the recession was coming. But come into January, everybody says, there's no recession. Every correction is to be bought. I must buy the dip because it's going up forever. And this is a new paradigm. And then we've come down. There was a denial all the way down. Denial of saying this is not a big deal. The virus is not a big deal. It's not an economic crisis. It's just a correction. And now I believe we are at the return to normal. The caveat to that is that we have never seen such such a big amount of policy response in such a short period of time. So this correction could go on for a long time, right? Because it is overpowering the bearish forces for now. But the bearish forces continue to work its way through the system every day. People, are still going to lose jobs. Unfortunately, earnings are still going to be reduced. In fact, maybe go to zero for some firms. Some firms will go bankrupt, and we will see that in time to come, right? But having said that, the volatility is very low. So how do we profit from this? It's a high volatility environment, and the reason is because there are various factors as to why the volatility is so high. First, the confusion factor is high. You can argue both sides of the coin, and even experts don't know what's going to happen because we are very dependent. We are very dependent on, our projections are very dependent on the path of the crisis, the spread of the virus. So it gives a lot of volatility to all this macro analysis, but also because of social distancing, many investment banks, investment professionals, they are all working from home. And when you're working from home, your mandate is not to take a lot of risks. It's not to go fully invested, but rather, try to be careful, because we don't know tomorrow if you're going to know your risk. Maybe the systems will fail, or maybe liquidity is and liquidity, meaning volumes, are much reduced at certain times of the day. As you can see, the stock market is moving 4-5% every few hours, as opposed to 2% the whole day on a good day previously, right? So for all those who lamented about low volatility, your dreams have come true. High volatility is here to stay. So the solution to this is to size appropriately. I think whatever product you're trading, what you use to size, think about the new regime now. For the same amount of risk, risk is proportional to the size of your positions as well as volatility of your positions. So now that volatility is much higher, please reduce your size such that you do not have to get stop out at levels that you don't want to stop out. Give wider stops because you see a lot of random moves that comes back quickly. I'm sure some of you who trade will have experienced this because of your trade sizes. You become overcommitted and you are unwilling to stop out because you think it's going to come back, and in fact it goes further than you think. And when you stop out, it finally does come back, and that's only way to remedy this is to size your positions appropriately and to focus on what is inevitable, right? I think many things changes from day to day. Policy implemented, news, how much the virus is, how many good news, how many pieces of good news you hear about the virus, vaccine development, drug development. But the inevitability of it is that there is no precedence in history of us ever finding a vaccine for a coronavirus. There is none. And we are trying to say that we can do it in 3 months because of AI. It could be, but it's very unlikely, right? If the best person, well, not the best person, if the foremost expert who has been investing billions of dollars in this area, in this world, believes that it's going to be done in only 12 months, if he can simultaneously invest billions in 7 different viable choices right now, and that's the best case projection from his part, I don't think there could be any possibility of thinking that it can be done in 3 weeks, right? So the inevitable is that whatever happens, the policymakers will continue to ease whenever something bad happens, right? They will continue to devalue fiat currencies. So find yourself hard assets that doesn't require a lot of leverage, and seek refuge in that. And another inevitability is that interest rates will stay very low for a long time. They will stay very low until inflation prints comes, which I believe right now, I think the probability is tilted towards inflation in some months to come, because we are already experiencing price increases in goods that in scarce supply, right? And as time passes, we're going to concentrate all our consumption to just a few things, right? And with production lines being shut down here and there, inevitably supply chain disruption, especially good quality stuff, will have inflation in the prices. So with that, I come to the end of this webinar. I hope it's been informative. I know there will be some bond vigilantes out there who remember the inflation, hyperinflation days of the past. One of the questions will be, oh, do I see hyperinflation? I do not see hyperinflation, because it's been so deflationary for the years, for so many years in the past. But I don't think we need to have hyperinflation to start to have repricing of many assets which used to do well, right? We just need to have some inflation, which I believe is quite likely. And in fact, for any of us who require medical services, education, and good quality food, we have found inflation in almost everything that we purchase. Anyway, with that, I hope that this has been useful. We'll move on to Q&A, but maybe Alex, you would like to start them off with some questions?
Yes, V. Just from a technical perspective, if you can just give me access to be the host.
Oh, yes, correct.
So I'll go through the questions, and Okay, so your first question, V. What are some of the good quality products that may get expensive? So you mentioned about looking to invest.
Right. So I think healthcare, good quality food. I think already now we are seeing food inflation in the stuff that you require. Australian goods are very expensive now. Not very, it's much more expensive than before in Singapore because of the breakdown in supply. chain, right? There's no flights flying, and there's very few flights flying, and most airlines, they actually lose money on cargo. They make money on passengers. So it's become very difficult to get certain stuff. You will find that um, you will find it's hard to come up with a list right now, but you'll find that medical services, education, and safe havens such as gold. I think gold, because of the quantitative easing, because of unlimited amounts of money, there's only finite amounts of gold.
Well, that was another question that somebody had about the immediate outlook for gold.
Yes, so I see that yes, the deleveraging eventually ends, right? Eventually you get tired of stopping out because of deleveraging. So you eventually will see. Of course, it's not going to be one smooth path, right? As you see, gold. If you look at gold prices, it's been really volatile these few days. If you look at the futures prices, it's gone up way more than the cash prices. I believe most of you, if you trade on MT4, you'll be seeing the cash price. It seems like it's not been moving. And if you've been reading my commentary, you're thinking, what's up with this guy? He says it's breakout, right? But if you look at the futures prices, it's gone up a lot because there were some problems with delivering gold. People who are short the futures contract, they couldn't take delivery of gold because there are no shipments going around to help them deliver gold to the futures people who are long the contracts. So that's one problem that the market is facing as well. So gold, I believe, yes, in the longer run, again, size your trades appropriately, size to last the long run, right?
Then there's a question with regards the second wave of infections in the US. Could that possibly be worse than the initial wave of infections, in your opinion?
Well, so it all depends on the policy response. The policy response so far has not been encouraging because they keep saying that, we've seen the peak and then we can reopen, then we can go back to work and life will be as normal. But if the Singapore experience is anything to go by, Singapore had only a few hundreds of cases, and then it stabilized. And then when the imported cases came back, within a week or two, they reached 1,000, and now they have hundreds every day, right? I think yesterday was 120 cases. And this is in a country, actually a city where the government is very strict, and the government is very proactive, and they do excellent contact tracing. They actually quarantine people who are close contacts or infected cases. I don't see that happening in the US unless something significantly changes. And the other risk of the US is that they have all these US presidential primaries, and the courts refuse to let them do it by mail, or they believe it ends, then they think, okay, the US elections is just in November, and they go to the polls, they start campaigning, and it's just like a horror movie, right? It's just a horror movie waiting to happen.
Okay, there's a question here, V, that obviously we've seen the S&P and even the Dow Jones starting to recover. The question is, why are those indices moving higher when we expect
Yes.
businesses and companies to shut down whilst we have these lockdowns?
Yes. So that's the crucial part about markets that always confuses the average person in the street who reads only financial press, right? Because when whatever you read in the press is what is happening right now, right? But the market prices what is going to happen, right? So when it was going down, the press was saying, it's just a small correction, but it just kept going down. It's limit down, right? And then when it's reached the bottom, the press is saying, it's the end of the day, end of the world. It's going to go down. It's going to be a depression, right? And then now the market is pricing in the money that is coming into the system, the unlimited amounts of quantitative easing, the fiscal $2 trillion fiscal policy from the US. That's US alone, but everywhere in every country in the world, they're printing a lot of money to subsidize all the unemployed, all the suddenly unemployed, right? So it cushions that, right? And it starts to allow a lot of panic selling was done in the last the last few weeks of March, right? And after you've capitulated, there's nothing left for you to sell. What's left is no more selling, right? So I think that's what's happening right now. I have to admit, I expected a bear market rally, but I was also surprised by the strength of this rally, right? And when I started to think about it, I think it's because it's unprecedented. It's because of the amount of policies that squeezed in just a space of 1 month, as opposed to it used to take a year for the policymakers. And in my mind, I was still thinking, and I think that's the mind of most experts who are thinking that we live in a world of the past where policymakers were just doing things very slowly and see what happens next. And then they'll debate the fiscal budget for 2 weeks and then do something about it. But surprisingly, every country in the world, when they saw the response from one country, they I guess it's much easier for politicians to spend money than to cut budget, right? When they say, "Hey, now I have a excuse to cut," right? Because the US is doing it, so I'm just going to do it anyway. So everybody has pumped in a lot of money, and I think that's why the asset markets are very supported right now. But you're right. I think the economic damage will slowly filter through. Bankruptcies will happen. Corporate. So one of the things that are failing right now is companies are being downgraded by rating agencies, right? So they used to have bonds that are investment grade, but because they're getting downgraded, then they become a lower grade, and then the investors who have it, their mandate doesn't allow them to hold non-investment grade. They need to sell. So that's the second wave, right? And we see that yesterday with two rating agencies putting Australian credit rating on negative outlook, right? Australia is one of the few AAA countries in the world, but they even Australia got a negative outlook, right? I think that's going to start to slowly happen. Rating agencies work very slowly, right? They need to look at the numbers, they look at the report, or say, oh, this guy is not making so much money, it's going to downgrade him, and that's the worst time for you to do. It's just imagining you have a mortgage, you have a loan at a bank, and they were happy to give you low interest rates when times were good. In fact, they encourage you to borrow. In fact, they want to send you free loans, pre-approved credit cards. And then now when things are bad, is when you really need these things, they say, hey, your credit rating is very bad. We need to increase interest rates on you. And we cannot give you new loans to support your business anymore. And that's what happens, right? Eventually, what the person who asked the question, what you say is correct. What that will filter through. So I think to answer the question fully, I believe asset markets is in a big range, right? It's being driven up by policy response, but it's going to fall because of economic damage and supply chain disruption and demand destruction. So we have these two conflicting forces.
All right, we'll just take a couple more questions before we finish up. So there's one here, V, is how do you see the Forex trading business in this kind of environment, and given that the recovery is going to be some time away still?
Well, it's okay. There's two parts to this, right? If you are invested in the business, you are the guys with the platforms, you're crushing it, you're raking it in. If you are looking for stocks to be bullish on, you check out on all the brokerage firms that have a Forex business or allow margin trading, and they're regulated well, and they are all making record profits. And I think the reason is because many average punters are getting stopped. Whether you're long or you're short, you're getting stopped left and right. Every day you get some stops, right? And they just make a lot of money. So on the Forex trading business, the guys who provide liquidity, they're just raking it in. But
I think the question is more regards us.
Yes, regards to us, right? Yes. For us, you have to understand that if you behave like the rest of the other guys, then you are going to contribute to that bonus pool, right? So you have to stop yourself from behaving like the rest of the average punters. The average punters will be trading the same size as before, right? You have to reduce your trading size, right? You have to have wider stops. If you used to have 10 pip stops, you think you can be insulated. It's not going to happen, right? The market moves in 20, 30 pips for no reason at all. So if you used to have 50 pip stops, I think you should have 80 pips or 100 pips, right? So that means you have to size properly. You need to have a wider stop.
Can I just,
Yeah.
sorry to interrupt, but you just want to add to that also. This is one of the things you might have noticed, guys, with the LTG portfolio updates. We're basically selecting trades off daily charts for that very reason, is because of that market volatility. By trading off and selecting opportunities on a daily chart, it provides us that wider range of stops, and also why most of our recent investments have been at the normal half of volume.
Yes, that's why LTG and track record works together, because we share the same philosophy. Where, in fact, we did the course for LTG before. So yes, sorry,
I just want to add, just whilst we're sort of speaking about the forex traders and brokers, there's just one other final question. There was a concern about brokers going bust and declaring bankruptcy, and how are our funds protected. So just for everybody, all client funds that the brokers hold are on a separate accounts. They do not have access to those accounts. So they are with various banks. So your funds, as I said, the brokers directly do not have access to those funds.
So the caveat today is the brokers endorsed by you guys, though, right? Because you check on their regulatory licenses and all. So if you go, so it's not all brokers, right?
That's correct.
There are brokers out there, so you got to be careful, right? It's not like I'm trying to hawk LTG's broker partners or whatever, but you have to find regulated counterparties, like it's regulated in Singapore, regulated in Australia, or at least it's endorsed by somebody you know, right? Because some of the broker partners are owned by people that we know. So those are segregated funds, right? Don't get involved with broker. So since 2008, 2008 had a lot of broker failures, right? Where even the regulated ones, they were commingling funds. So then one guy lost a lot of money, means everybody lost a lot of money. But now it's all segregated accounts. Your money is your money. It doesn't matter if the firm loses money, right? It's held in custody for you. So trade with reputable brokers. When in doubt, you can ask Alex, and he will tell you. Yeah.
All right, I think we'll finish up there, everyone. So, V, thank you very much for your time today. I trust that everybody...
Wait, Alex,
yes.
I know,
Yes.
sorry to interrupt. I know we are a bit running over time, but I want to finish off my thought on the forex trading business. It's not all bleak, right?
Sorry.
The sizing and the volatility, it requires you to have wider stops. Adopt what Alex was saying. Maybe you look at the daily charts instead of looking at a minute charts, right? I think many people try to trade on minute charts. I think that is over now. You're just gambling, right? Try not to gamble, because there's opportunities to be had, and this is crucial, because right now, even as Alex alluded to, I speak to many investment managers in the world. Some manage huge amounts of money. They are as lost as we are, right? They have conflicting views, right? And everybody is like this. So this is the time where there are many opportunities, right? Because if you pick on the right trend, you could make a lot of money. But what you need to know is that when you get it wrong, you need to stop out, right? And you need to have your stops in a way that it has to be not stopping you out because of randomness. So reduce your size, have wider stops, and read our dailies regularly. That's my thoughts. I trade every day, and that's up to date with all the things that I read and the people that I talk to.
Okay. Well, thank you again, V, very much, and certainly look forward to continuing these, what we're going to call special edition webinars on a regular basis. And for everyone else, thank you again for joining us today. For those who do celebrate Easter, I wish everybody a happy Easter. Please stay safe. For those who don't celebrate Easter, enjoy the long weekend. And the LTG offices will be closed Friday, obviously Good Friday and Monday, but back to normal operation today. So again, thank you very much. Stay safe and enjoy the long weekend. Bye-bye.
Thank you. Bye-bye.